Hello everyone, welcome back to my channel. Today we are going to cover simple yet powerful trading strategy with Donchian Channels and William R. This strategy is designed for Bank Nifty and it works on 5-minute time frame. I will explain the examples, rules, my personal recommendations. So stay till the end. Let's get started. So in this video, first we will cover the strategy details, then I will explain what are the rules, and then I will show you a couple of examples. Finally, I will show the backtest results that I backtested from 2011 till 2024, and then we will continue with my recommendation towards the end of the video. So let's go into the strategy details. It works on the Nifty Bank and I have backtested on the index spot. The strategy type is intraday. That means we open the position in a day and then close by end of the day. It can be long and it can be short. And the time frame is 5 minutes. And these are the indicators that we are going to use. William %R with length 100, Donchian Channel with length 80, and average true range with length 10 for entry and 500 for SL. Let's look at the buy rules. As you can see in this chart, we are looking at William %R. So here this value is higher than the previous value. So we have our buy signal. Once we have our buy signal, we will place the entry order at a price above the Donchian Channel high. So here we will take that high price at this candle plus 1.5 times of ATR. Once we got our entry price, we place the entry order in our broker terminal. If it is not triggered, we will delete after 5 hours, which is nothing but 25 minutes in this 5-minute time frame. But if the order gets triggered, then we place our stop loss, and the stop loss formula is entry price minus 2 times of ATR. If the stop loss is not hit, we will scare off at 315. Let's look at an example. So if you see in this chart, till here the market is in range bound. We should only look for the candles which are near to either Donchian Channel high or Donchian Channel low. Since we are looking at buy example, let's look at the candles that are closer to the Donchian Channel high. So our first condition should be William %R is rising. For example, if you take at this point, the William %R is rising. So this is where our buy signal generated. But our entry price will be Donchian Channel high at that candle plus 1.5 times of ATR. So this will be roughly our buy price. As you can see, next 5 candles, it is not triggered. So we cancel that order. If we continue for the whole day, then at this point the William %R is rising, where our buy signal generated, the William %R is minus 8.38, which is higher than the previous candle value, minus 16.6. Once the buy signal is generated, we take the Donchian Channel high at that point. You can see the Donchian Channel of 80 length, high value is 51307.05. That is what we used here, plus 1.5 times of ATR. Here at this candle, the ATR length is 48.78, and then that is our buy price. So here we have placed our buy price with 51380.2. As you can see in this candle, the buy price is triggered and then we have successfully entered into the position. For the stop loss, the formula is entry price minus 2 times of ATR. The reason for using 500 for stop loss is to capture the long-term volatility. With this formula, we are getting 51271. So it comes roughly at this place. From this point, we did not hit our stop loss. So we exit our trade at 3:15 p.m. So with that, our profit is 468 points. Considering the Bank Nifty is 30 quantity, we make 14,000 rupees on this particular trade. Let's look at the sell rules. So it is exactly opposite of the buy rules. So the William %R should be in a falling condition. If it is in falling condition, then we have our sell signal, and then we can calculate our entry trigger price using this Donchian Channel low minus 1.5 times of ATR. Again, same rules, within 5 hours, which is 25 minutes. If the order is not triggered, we will delete the order. But if the order is triggered, then we place our stop loss using this formula, which is entry price plus 2 times of ATR. For entry, we are using length 10. For exit or stop loss, we are using length 500. The reason again is for entry, we want to capture the short-term movement, but for stop loss, we want to capture the long-term volatility so that we don't get stopped out too quickly. If we did not hit our stop loss, then we square off at 3:15 p.m. Let's look at one of the example for sell entry, where William %R is falling. Once our sell signal is generated, then we calculate our sell trigger price using this formula, Donchian Channel low minus 1.5 times of ATR. So here Donchian Channel low is 51,158. So we got our entry price as 51,039, which is this blue horizontal line. As you can see, our entry is triggered after placing the order at the fourth candle. Once we are in the trade, we place the stop loss using this formula. We did not hit our stop loss, and at the end of the day, we close our trade at 315. With this, our profit is 238 points in this trade. With the 30 quantity of Bank Nifty, our profit is 7,100. Some of the important considerations that you should remember is you should not take more than 3 trades in a day. You should not take any entry before 9:20 am and after 3 pm. So if you are already in trade, you should not take new trade. Now let's look at the backtest results. I have backtested this exact trading strategy that I mentioned just now from January 2011 to November 2024. I have used Python for backtesting this, and the total return is close to 600% over this period. And if you look at the drawdown, there are no longer drawdown periods, as well as drawdowns post 2020 is almost consistent. With that, I have considered trading capital of 2 lakhs for trading one lot. This is considering either selling Bank Nifty options or trading in Bank Nifty futures with current contract sizing. So the average yearly returns is 44%, and the maximum drawdown you can see is minus 20%, and return by drawdown ratio is 2.2. It basically tell you may lose 20% at any point of time, but you are making in a year 44%. As long as it is more than 1, we are good. And I have considered in this strategy the slippages 0.1%, and I have considered the brokerage, which is 20 rupees per order, which is standard across all brokers. Plus, I have included GST, STT, all kinds of government charges. This is starting from 2011 all the way up to 2024. You can see there is no single loss making year, and the worst year is 2023 with 19.9%, and best year is 2020, which is more than 100%. And you should look at this monthly return chart very carefully. So if you look at year like 2015, starting from March all the way till December, there is no single loss making month. But at the same time, if you look at in 2019, you have 3 continuous loss making months from October to December, and that may be recovered in 2020 March. So you have to be ready for this if you are doing the systematic trading. Only thing you should note here is that the drawdown days are 160. That means close to 5 months you will be in a drawdown, and Sharpe ratio is 2.3, which is very good if you know what that means. And R square of the equity curve is 0.98. Generally above 0.95 is pretty good. So if you look at the day wise, the win rate is 43%. That means only on 43 days out of 100 days you make profit, and on 57 days you make loss. But when you win 2.2%, but when you lose minus 1.1%. So that's why risk reward ratio is 2.03. So you should not look at only win rate or only risk reward. We should look at expectancy. So on an average, every day you make 0.3%. So generally you have this doubt when to stop trading this strategy. So if you look at the backtest, the drawdown is 20%. So if you keep that in mind, definitely you are going to hit more than that when you start trading live. So you should not stop trading the strategy when you hit 20% drawdown. That's where we look at the Monte Carlo drawdown results. The trades are randomly shuffled, and then we got our drawdowns. So with 95% confidence, we can say the drawdown will not exceed 43%. But if it exceeds, then you should stop trading this strategy. So the limit for this strategy is minus 43%. If you lose this, then you should definitely stop trading this strategy. So here is the interesting finding I made after considering the slippage and charges, how much the returns we are losing. Before the charges and slippages, we are making on an average 56% yearly. And after considering charges and slippages, we are only making 44%. So we are losing almost 12% for slippages and charges with one lot trading on the Bank Nifty futures. And drawdown increased from 17% to 20%, and return drawdown ratio reduced from 3.19 to 2.2. So you should always consider slippages and charges when you are looking at backtest results. That will give you a real picture. So the profitable strategy can become loss-making strategy if you consider slippages and charges. As you can see, from 2011 to 2024, we are making consistently profit year on year, and the equity curve is pretty linear, and it is going up. Overall, we made returns of 600% in 14 years, Overall, we made average yearly returns of 44% over this last 14 years with a drawdown of 20%. That makes it return by drawdown ratio of 2.2, which is more than 1, which is pretty good according to backtesting trading strategies. And the win rate is 43%, but along with win rate, you should look at risk reward, which is 2.03, which is pretty good. You can only trade this strategy on futures. Either you can buy ATM option or you can sell ATM option. So if you are not comfortable with this drawdown, there are 3 ways you can reduce the drawdown. So instead of considering 2 lakhs for one lot, if you consider 4 lakhs for one lot, your drawdown will reduce from 20% to 10%, but your yearly returns also will drop from 44% to 22%. So you should be okay with that, but your ratio remains the same. Also, you can construct option strategies to reduce the risk. And if you are trading multiple strategies, then you will not feel the heat of this 20%, because when this is in loss, other strategy is making profit, so you will not see the effect of this. So you have to remember, like any trading strategy, you have to backtest this strategy before you go for live trading. And you cannot make money with single strategy. You will basically need multiple strategies. Then only you can survive in this market. So, should you trade this strategy? This strategy is a very good addition to your trading strategies, but no single strategy is very good enough to make money in the market. So the risk management is the key. If you find this video helpful, hit the like button and subscribe for more videos. Comment below if you have any questions. I will see you in the next video.